There's an old joke that circulates inside the dairy industry, and like most good jokes, it's mostly true. Only 5 people in the world actually understand how milk is priced in the United States, and 4 of them are dead. Think about that. You're looking at an industry that produces over 230 billion pounds of milk a year, and the pricing system behind it is so layered, so deliberately complicated, that even the American Farm Bureau has described it as one of the most complex commodity pricing regimes across all of agriculture. And yet people buy dairy farms every year, sometimes without understanding even the basics of how their paycheck gets calculated. Some of those people do fine. Some of them quietly lose everything. So here's what this video is about. We're going to break down the real economics of owning a dairy farm, herd financing, how milk is actually priced, and the one cost that will make or break your margins faster than anything else. I've spent a lot of time inside these numbers, and there are a few things in here that will genuinely surprise you, including one structural problem buried in federal policy that almost nobody talks about, even though it moved hundreds of millions of dollars out of farmers' pockets in a single quarter. We'll get there. But first, let's start with the thing most people get wrong before they ever buy a single cow. The number that sounds big but gets bigger. Getting a dairy operation off the ground requires close to $1 million in startup capital in the first year alone, covering milking systems, farm construction, specialized refrigeration, and livestock. That sounds like a lot. It is a lot. But here's where people get tripped up. They look at that number and they think of it like buying a machine. You pay for it, it runs, it makes money. A dairy farm doesn't work that way. A starting herd of 250 active cows at roughly $2,500 per head puts your livestock cost alone at $625,000, and that's for cows that are already milking. If you're building your herd from younger stock or raising your own replacements, the clock starts ticking before a single drop of milk hits the tank. If herd health issues delay peak milk volume past your initial projection, your financial runway shortens immediately. And then there's the 2-year problem that almost nobody talks about when they're dreaming about owning a dairy. A dairy cow doesn't just walk onto your farm and start producing. It takes close to 2 years from the time a calf is born until she's mature enough to join the milking herd and start generating any revenue at all. So every heifer you're raising right now is a 2-year capital project. Feed costs, vet costs, housing costs, with zero return until she freshens. Most people picture a cow as an immediate income source. The reality is closer to a long-term investment with a delayed payoff and daily expenses the whole way through. So you've got $1 million entry cost, a herd of animals that take 2 years to become productive, and expenses that start on day 1. That's the setup. Now let's talk about how you actually get paid. This is where dairy farming gets genuinely strange, and it's the part that even experienced farmers sometimes don't fully understand. You would think that if you're a dairy farmer, you sell milk and you get paid for milk. But that's not really how it works. Federal milk marketing orders translate surveyed wholesale dairy commodity prices into minimum class prices and a pooled uniform price from which farm milk prices are constructed. In plain English, that means your paycheck isn't based on the milk you produced. It's based on what a processor somewhere else turned that milk into, and what those finished products sold for on the wholesale market. Under the FMMO system, milk is classified by 4 uses. Class 1, fluid milk. Class 2, soft products like cottage cheese and sour cream. Class 3, cheese, and Class 4 butter and non-fat dry milk. The component values used to determine each class price are based on wholesale prices of cheese, butter, non-fat dry milk, and whey. So your farm's milk gets sorted into one of those 4 classes based on what the processor does with it, not what you do with it. And then the price you receive traces back through a formula that starts with the wholesale price of cheddar blocks and butter. Your paycheck is essentially a downstream echo of the cheese and butter markets. The milk market, as most people understand it, doesn't really exist for the farmer. And here's where geography becomes money. Where your farm sits on a map can be worth thousands of dollars a year, completely independent of how good your cows are. Class wine price differentials, the regional adjustments built into the federal formulas, range from $1.60 per hundredweight in the upper Midwest all the way up to $6 per hundredweight in Florida. That means 2 identical operations, same herd size, same milk quality, same management, can have dramatically different revenue just because of which state they're in. That's not a market outcome. That's a federal formula, and it's baked in. Now you might be thinking, okay, complicated pricing, regional differences. That's just the cost of doing business in a regulated industry. You learn the rules, you play the game, and that's fair. But here's the thing that I want you to hold on to, because we're going to come back to it. The rules themselves can change, and when they do, the consequences can be enormous and fast. Remember that. We'll come back to it. Let's talk about the thing that actually determines whether a dairy farm survives from year to year. And it's not milk prices, it's feed. Feed costs represent approximately 49% of the total economic cost to produce milk. Nearly half of everything it costs you to run a dairy farm goes into the mouths of your cows. Feed costs represent 40 to 60% of the total cost of production, about 4 to 5 times the cost of labor, usually the second highest cost. And here's the brutal part. Most U.S. dairy rations run on corn and soybean meal, and those markets don't care what your milk price is doing. Corn goes up because of a drought in Iowa or an ethanol mandate in Washington, and your feed bill goes up whether your milk price went up or not. Your revenue and your biggest expense are priced in completely different markets, and they move independently of each other. There's actually a name for the number that tells you whether you're making money in a given month. It's called income over feed costs, IOFC. What you want to know is how much milk revenue is left after feed gets paid. That's IOFC, and it's the figure that actually tells you whether your operation is generating margin. Experienced dairy farmers track this monthly, sometimes weekly, because a bad IOFC month in March tells you something that won't show up in your bank account until May. That lead time is worth something. Now here's a number that should stop you cold. U.S. total economic cost hangs around $23.56 to $23.66 per hundredweight, while projected all milk prices are just $18.95 per hundredweight, implying an economic loss of around $4.71 per hundredweight. The economic profit margin, return above all costs, was negative $409 per cow in 2024, and the average dairy farm covered feed costs in all years from 2000 to 2024. Operating costs during most years, but total economic costs in only 4 years. 4 years out of more than 2 decades. That's the real picture. So how are farms still running? A few reasons. Larger dairy farms have lower costs per unit of milk produced, though some dairy farms in all size classes have been profitable. Scale matters enormously in this business. In 2021, USDA pegged the total cost to produce 100 pounds of milk at $40.70 for herds under 50 cows versus $19.14 for herds of 2,000 or more. That's not a small gap. That's a completely different business. And the industry has been consolidating hard because of exactly this math. Licensed herds fell from roughly 45,000 in 2014 to 24,011 in 2024, then to 23,609 in 2025. U.S. milk production increased 32% from 170.8 billion pounds in 2004 to 225.9 billion pounds in 2024. More milk, fewer farms. The farms that survive are the ones that figured out how to produce at scale or found a way to hedge the margin gap. Which brings us to something most people have never heard of, and it's genuinely one of the more clever financial tools in agriculture. There's an insurance product specifically designed for dairy farmers that doesn't hedge milk prices. It hedges the spread between milk prices and feed grain prices. The Livestock Gross Margin for Dairy Cattle program lets farmers buy subsidized margin insurance based on futures prices for Class 3 milk, corn, and soybean meal. The indemnity gets paid out based on changes in that insured margin during the coverage period. So you're not just betting on milk going up. You're protecting against the situation where milk goes sideways and corn goes up at the same time, which is exactly the scenario that wipes people out. Most people outside the industry have no idea this product exists, and even some farmers who know it exists don't fully use it, which leads us directly to the most important thing in this video. Remember that open question I left earlier about what happens when the rules change? Here's the answer. In 2025, USDA updated what are called make allowances inside the Federal Milk Marketing Order pricing formulas. Make allowances are basically credits that represent the cost of processing milk into finished products, cheese, butter, powder. When USDA raised those allowances, the effect was immediate and enormous. Farmers lost more than $337 million in combined pool value in just the first 3 months, with class price reductions ranging from 85 to 93 cents per hundredweight. That's a rounding error sounding accounting adjustment, a processing cost credit buried inside a federal formula that moved $250 million out of farmers' pockets in a single quarter. Until the 2025 final FMMO amendments, make allowances had not been updated since 2008. So when the adjustment finally came, it came hard. And this is the thing about dairy farming that makes it genuinely different from almost any other business. You can do everything right. Great herd, great milk quality, good management. And then a line item inside a USDA formula changes, and your revenue drops by nearly $1 per hundredweight before you've changed a single thing on your farm. There's also the leverage problem. A dairy farmer has almost no ability to hold product and wait for a better price. A grain farmer who doesn't like the market can store a harvest in a silo and wait 6 months. A dairy farmer can't do that. New milk has to move to market constantly, whether prices are good or not. That structural reality puts producers in a genuinely weak bargaining position, and it's one of the reasons the federal pricing system exists in the first place, to put some floor under what would otherwise be a completely unequal negotiation between individual farmers and large processors. The government has also tried other interventions over the years, with mixed results. There used to be a federal program that literally bought surplus cheese and butter directly from the market to prop up prices, which is where America's infamous government cheese stockpiles came from. The government became one of the biggest cheese buyers on earth just to maintain farm income, and because that program guaranteed a buyer for any amount of production, farmers just milked more cows. More cows, more milk, more surplus, more government cheese. The program created the very problem it was trying to solve. It eventually got so bad that the government actually paid farmers to exit dairy farming entirely, a program that compensated producers to slaughter or export their herds just to get production under control. That's the history, and the echoes of it are still in the system today. So let's bring it all together, because by now you have a picture that's very different from what most people imagine when they think about owning a dairy farm. You're looking at a capital-intensive entry, close to $1 million before you're fully operational. Your herd takes 2 years to become productive from birth. Your revenue is calculated by a federal formula tied to cheese and butter markets, not milk markets, and your geography affects that revenue in ways that have nothing to do with how well you run your operation. Your single biggest cost is feed, and it's priced in a completely different market than your revenue. The average dairy farm has run below total economic cost in all but 4 years over the past 2 decades. And a single administrative change to a processing cost credit inside a federal formula can cost the industry hundreds of millions of dollars in a quarter. The farms that make it work are the ones that understand all of this going in, not after the first bad milk check arrives. If you found this genuinely useful, and I think you did, drop a comment below. Tell me what surprised you most: the pricing formula, the feed cost reality, or the government cheese story. I read every one of those. And if you want to go deeper on agricultural economics, there's a video right here that goes inside the ranching world with the same level of detail. The numbers, the leverage problems, the things the listing photos don't show you. It's worth your time. Hit subscribe if you want more of this, and I'll see you in the next one.